Today we want to consider why your setups fail, why your trading setups fail, why your demand and supply zones fail, why your smart money setups fail. Now, I get asked most of the times when people see how most of my setups play out. Those of you in my free Telegram channel, those of you on my Instagram, those of you on my TikTok and even Facebook and YouTube, in our community, you see that most of my setups do play out. Once I say this trade is gonna sell from here or buy from here, when price comes to our point of interest, our POI, the market always most times respect my setups, respect my point of interest. So I get asked most of the time by struggling traders what actually is my secret and how I get those setups. And not only that, why my setups always work out, why theirs don't work out. So that is why I'm making this video today, so that to share with you the secrets. I want to share with you the secret. This is going to be a series. Okay, this is going to be a series. So over the past coming weeks, we want to be going deeply into the reasons why your trading setups fail. This will actually improve your trading journey. It will give you more progress in your trading career. Now, I got all this through countless number of years of practice. Practice has helped me to be able to know the reasons why your setups fail, and it has helped me to do the right things and help me to master the art of trading, and my setups always pass. This is born by years of practice, and I'm going to be sharing with you my years of practice, the secrets and I've learned from my years of practice. Okay, so do not fail to watch all the series of this particular concept I'll be sharing with you over the coming weeks. All right, so the number one reason why your setups fail is the one reason is that you trade against the higher time frame trend or order flow. You trade against higher time frame trend or order flow. This is very, very key. If you trade against the order flow, or what the layman trader call trend, it will actually impact on your trading. If you trade against the order flow, if you trade against the trend, if you trade against what is also called the market structure, you would most likely be against your trade, will most likely not work out. All right, so there are two types of trends. Okay, if the market can either be moving on an uptrend, or the market can be moving on an uptrend or a downtrend, or the market could be ranging. Okay, the market could be moving in an uptrend. This is bullish. The market could also be moving in a downtrend, which is bearish, or the market could just be ranging. All right, this is called consolidation. Okay, consolidation, or what is also called ranging. Okay, consolidation. So these are the three phases of the market. So you need to ensure that if you are buying, you are in a buying market, which is on a bullish trend. And for a bullish market, the market is making higher highs and higher lows. I always say this is a higher high, higher low, higher high, higher low. This is a bullish market. The market is making higher highs and higher low. So you should always be taking buy trades here. Buy trades only, buys only on this kind of a market. All right, and mind you, I'm not talking about using trend line to know when the market is bullish or bearish. That is not reliable. Okay, using trend line, because if you're using trend line, you could have something like this and all that, so it's not reliable. So use market structure to know when the market is buying or selling, or when you are in a bullish market or in a bearish market. Now your market could also be doing, this is a bullish market. I just showed you a bullish market. When the market is in a bearish market, the market is actually forming higher highs and higher lower lows, lower highs and lower low, lower low, lower high, lower low, lower high, lower low, lower low, lower high, and like that. Okay, this is a bearish market. So in this market, you are taking only sales only. Sell trades only. Okay, sell trades only in this market. So this is a bearish market. So you need to ensure that you take sell trades only. So if you take buy trades on a sell market or in a bearish market, your setups will definitely fail. Your setups will definitely fail. How do I mean? Now watch out. Now if you have a bullish market like that and like that, okay, higher highs and higher lows, and perhaps at this high now, this is a supply zone. All right, this is a supply zone here. Now even though it's a supply zone, you don't need to take a sell trade from this market, because it is a bullish market, is a bullish trend. All right, so if you want to come here to sell from here, you discover that the market might give you a bit of the cake and continue to buy. All right, so that is why you don't need to do that. All right, for here now, this is also a supply zone, but you see that the market broke up here because it's in a bullish market. This is a supply zone as well, but the supply zone is where you sell from, right? A supply zone is where you sell from. It's a sell zone, or a bearish order block, as some traders call it. But you don't have to take the sell trade from this order block or this supply zone, because it's in a bullish market. So the market will break through it. The market will not respect your buys your sell trades on a bullish market. All right, now, so this is a wrong place to sell, even though it's a sell zone or a bearish order block or a supply zone. Now the same applies for a demand zone. I'll show you in the chart just a while. Just stay with me on this. So this is the first. I'll show you the first reason why your supply and demand zones or your setups fail. Now the second one, now on the flip side, for the market is forming lower lows and lower high. Okay, lower lows and lower high. This is a bearish market, and you can see this is a demand zone, but the market broke through this zone. This is a demand zone, market broke through zone. This is a demand zone. A demand zone is where you should buy from, right? Ordinarily, all right. Okay, by default, a demand zone is a buy zone, but the market broke through it. Why did the market broke through it? The market broke through it because it is a trade against the momentum. Now, trading against the trend is like trying to catch a falling knife. All right, trading against the trend is like trying to catch a falling knife, and it results in an injury. All right, or standing in front of a moving vehicle or a moving truck. Okay, it results in disaster. All right, so, or trying to catch the tide. All right, it results in disaster or injury. All right, an accident. So that is why you don't need to take trades from. Against the trends. All right. So in this case, the right trades on this case would be sell trades, because you are moving with the momentum. Sell trades only. Sell trades only here. Sell trades only. Okay. If you have another zone, sell trades only. Sell trades only. So that is where this is what you should do. And if you're on a bullish market as well, bullish market, instead of taking sells, you go for buys, because the market would actually mitigate those buys, and your buy zones, and it will sell. So this is the first and the foremost thing you need to know. When you see a setup, ask yourself, when you want to take a trade, ask yourself, what is the market structure? What is the trend? Some people call it trend, some people call it market structure, some traders call it order flow. All right, whatever name, they all point out to the same thing. All right, so ask yourself a question: what is the trend of this market? What is the trend of this market? Am I on the right trend, or am I against the trend? If you're not on the trend, no matter how good the setup may appear, just do not take that trade, because your probability has reduced. The probability of that trade working out has greatly reduced. All right, so number two, the second reason. Okay, let me show you some chart example before we go to the second reason. Some chart examples that shows that. Now let's see. I've actually pointed out some chart examples so as to make not to spend much time. Okay, here now you can see in this case, the market here was on a bullish market. It is a bullish trend. Okay, this is a bullish trend. Market was forming higher highs and higher lows. So this setup worked out. So this is a good setup. All right, it's actually on the trend. Can you see? This is a bullish trend. So this is a good setup. All right, the market is trading with the trend. All right, it's a good setup. Okay, but you can see in this case, if I should take this trade, this is a supply zone. If I should take this trade, it's gonna result in, it resulted in a loss here. So this is a better setup because it's in line with the trend. This is another one. So this is also as well, this is as well a good setup. It is in line with the trend. All right, so this is what you should be doing. This is as well a good setup because it's in line with the dominant trend. This is a good setup. Okay, good. Now these are bad setups. This here is a bearish market structure. Is a bearish market structure, and in this case we are like trying to take a buy trade here, and you see that it failed. Here as well we are trying to take a buy trade, and you can see it's failed. Trying to take a buy trade on a bearish market structure is suicidal. All right, trying to take a buy trade on a bearish market structure is suicidal, and trying to take a sell trade on a bullish market structure is suicidal, and it often results to a loss. All right, it results to a loss. That is why you need to avoid that. Here now you can see the case. Now here these are bad trades because it's against the trend, but here this is a trend sell trade, and this trade is a good trade. It's a good trade because, and it worked out because the market is on a bullish and is a bearish phase, and it is in line with the trend. Okay, it's in line with the trend. So the market played out here. Okay, so here as well you can see here as well this is a bearish market structure here. Here in this case the market structure has changed. And some traders would want to take a sell trade on this bullish market structure. You can see there was a piece of the cake. The market sold a while and stop loss was taken out. So ordinarily, if this were supposed to be on a bullish market, the market should have sold down to this point at least. All right, so but it failed because the market structure was bullish or is bullish, and the trader did not try to take. So the market structure was bullish, but the trader tried to take a sell trade, which is against the flow, or which is against the dominant trend. All right, so that is the first reason why your setups fail. That's the first reason why your setups fail. Now the second reason why your setup fail, I just said the first reason why your setup fail is trading against the trend. Now the second reason why your setups fail is when you enter trades or you take trades without entry confirmation. I've said this time and time again. Entering trades without entry confirmations. Okay, taking trade without entry confirmations. What are entry confirmations? Now I've always said it that there are two ways you can actually enter a trade. You can enter a trade through a normal limit entry method, and two ways to enter a trade. You can use limit entry, and you can actually also use the confirmation entry. Stay with me on this. This video is going to do a lot for you. All right, entry confirmation method, limit entry method, or the confirmation entry method. Now the limit entry method, as I've always said, was propagated by Sam Dearden, a US trader. And what does that mean? It means that on a zone, when you identify a zone, maybe you see a zone like this, like let's say you have a zone of this nature, a demand zone. You just place a buy limit order right here at the entrance of the zone, so that once the market comes to the zone, your limit order will be activated and you expect that the market is going to buy, and your stop loss will just be few pips below the demand zone. This is a demand zone. All right, demand zone. So few pips below the demand zone. All right, so it works out sometimes, and in a bearish market, you have your market like your demand zone that way, and then a sell limit order is placed just at the entrance of the zone in anticipation that the market will come, activate your sell limit order and sell, and your stop loss placed just at the other side. Here you have your stop loss at the other side of the zone. This works out sometimes. We place also called the set and forget method, in the sense that you just place your entry, your buy limit or your sell limit, and place your stop loss, and you go and sleep, or you go to sleep, or you go about your day's business. All right, but it works out sometimes. But the problem with this strategy is that in certain times as well, the market would come to that zone, activate your buy limit order in this case, and still continue in the sell direction and hit your stop loss as well. Hit your stop loss. And sometimes the market will come, will activate your limit order, hit your stop loss, take out liquidity around here, and also buy. Can you see that now? Two things. The market can come, activate your stop loss, activate your buy limit order and buy. This is a scenario, this is a possibility, as you want. The market can as well activate your buy limit order, come down as well, activate your stop loss, take out some liquidity, and still buy. Now the trade worked out, but you are taken out. All right, so also in this case, in the bearish case, the market can activate your sell limit order and buy, and you make profit as you have anticipated. Also, the market can also activate your limit order, sell limit order. Also now, instead of selling, can still continue to buy and hit your stop loss and continue to buy. As well, the market can as well activate your buy limit order, your sell limit order, activate your stop loss, take out liquidity above the zone, and still sell. So you can still sell, but you didn't make money. Your stop loss was hit. So that is why, as traders evolved, and from experience and practice, traders now devise a means of reducing this scenario of losses, and most times stop using this limit entry method. And what replaced this limit entry method is now called the entry confirmation method. And what does entry confirmation method state? It states that when price comes to the zone, instead of you getting into the zone, you look for some signs that the market is going to buy if it were in a demand zone, and you look for some reasons, some signs that the market is set to sell if it were in a supply zone. And what do we do? What we do is that if you have like a supply zone right here, and we wait for the market to come to the zone. The market comes into the zone and give us some reasons to believe that the market is going to sell. And what reasons are? The market creates what is called the change of character and return to order block. Change of character means breaking microstructure. And if this were to be like a H1 or M30, we step down to like 5 minutes or 15 minutes, sometimes even 1 minute, and we look for a micro break of structure, a reversal pattern, reversal micro break of structure, which is the change of character. I've made a separate video on this. Please ensure to go to in the comment section, not comment section now, in the description box of this video. I actually put the link to the video I made on entry confirmation method. So you need to know that as a smart money entry confirmation method. So you need to look for here demand change of character on a lower time frame, and now you return to order block, and now you now get into the trade right here. And in fact, it will also help you to reduce your stop loss, because instead of to place your stop loss at a larger zone or H1 or M30 zone, you place your stop loss just at the M5 or M15 zone, after your change of character, your stop loss will now be here, just right here instead of here. So it has a lot of advantage. Number one, it helps you to, it increases your it gives you higher probability. It gives you higher probability of your trades. And number two, it also gives you higher risk to reward ratio. Okay, higher RR, 1:10, 1:6 or thereabout. In a case where you would have had 1:3, if you have to use the the larger zone. All right, so you now have the market sell down. So that is very, very important. It's called the smart money entry confirmation method. I've made a detailed video on this. Try and view it. Is in the link to that video is in the description box of the video. Try and view it. It helps you to be grounded on this. Now let's see a buy scenario. For a buy scenario, we have a buy zone right here. We have a buy zone right here. Now instead of just placing a limit entry here, we so for a buy zone, like I said, for a buy zone, instead of placing a limit entry here, we just allow the market to come in right into the zone. And when the market comes right into the zone, this could be H1 or M30, just as I've depicted on a buy scenario. And what do? We go down, step down to lower time frame like M1 or M5 or even M15 at sometimes, but better M1, M5. And now we wait for the change of character, bullish change of character on the micro time frame, and now return to other blocks, which will now buy, and we have a reduced stop loss right here instead of taking the larger stop loss. So you have higher risk to reward ratio and a higher probability. Okay, so that is second thing. So this second reason why your setups fail is that you trade without entry confirmation. All right, that is the second reason why your setups fail. You trade without entry confirmations. Very, very key. You trade without entry confirmation. So this is the second reason why your setups fail. You trade without entry confirmation. Very, very important. All right, very, very important. So the third reason why your setups fail is because you are combining retail. You are combining retail plus demand and supply. All right, demand and supply method, or the SMC. How do I mean? I've seen traders that they trade demand and supply, or they trade the smart money concept, but they still add some retail concepts. And when I say retail concept, what do I mean? You are using trend lines. You're using trend lines, or you're using trend lines or indicators. So the first thing I do for most of my mentees, once you come into my mentorship class, I ask you to remove all indicators from your chart. You're right. I ask you to clear your chart. You use what is called a clean chart. Okay, so you can see, you can never see any indicator on my chart at any point in time. You can never see any indicator, be it Bollinger Bands, be it trend line, be it volumes indicator, whatsoever. You cannot see, because all the information you need to trade, to make your trading decision, is on your chart. You don't need extra indicator or trend line whatsoever. The reason why I don't use indicators is that indicators are lagging. All right, indicators are lagging. They are lagging. And why are they lagging? Lagging is that they follow they occur, or they are printed on your chart when the price action has happened. They lag behind. Indicators lag behind price action. So why would I wait for a lagging tool when I can get the information firsthand from the chart, from a price action? on my candles. They lag behind candles because indicators take an average of maybe 30 to 20 candles, previous candles, to print your to actually print a signal, like for example your moving average indicator. It takes an average of the previous candles, what has happened before, to predict the direction of the market. And why should I wait for a lagging indicator? No, it will reduce your success. And another reason why you shouldn't use these indicators is that it creates confusion. Let me show you an example of what I mean. Let's say some traders want to use, they believe that when they lower a lower and a higher moving average cross, it signifies a bullish trend, right? This is what you learn when you start up trading. Maybe you have like a 20 EMA and your 50 EMA. All right, your 50 EMA. So when they have crossed to the upside, it signifies a bullish market, and also when they cross to the downside, it signifies a bearish market. All right, but this is not always the case. Let me show you. Let us install an indicator on this chart. So let's just install a moving average indicator. Let's install a moving average indicator. Let's say okay, this is let us just leave that one. This is 50. Let's install the 50 EMA, and let us call this, let's use a red color. So we have installed the 50 EMA. Now let us install the 20 EMA. Let's install the 20 EMA on this chart. 20 EMA. Okay. Okay, 20 EMA. Let's have this. Just stay with me. I'm just trying to prove a point to you. I'm trying to prove a point. Let us give it another color. Let's say a green or a blue color. Green color, as you would do. So now let's go to the chart. So you can see now we have imputed this indicator on the chart. Can you see the confusion here? Can you see the confusion right here? This is confusion. If you are trying to take trades from here now, you can see that the market, you cannot get clear signal here. Now this one appears to show a bullish market, but it would, for example, now look at, in this case, see, in this case, it just creates confusion. What about in this case? What do you trade here? Here as well. Let me look at, can you see the confusion here? It just doesn't work. Indicators don't work. Okay, so like in this case now, the market broke the EMA, the 20 EMA to the upside, and from the EMA rule, it's assumed that the direction of the market was going to change from here to bullish phase. But you can see now the market this is actually a supply zone. This is a supply zone, and the market just came right here to actually sell. Okay, so the EMA can actually cause confusion. Sometimes it might help, but most of the times it can cause confusion for you as a trader. So it's just better you just remove all EMAs or all indicators from your chart, so you can have a clean chart. All the information you need is right there. All the information you need to trade successfully is right there on your chart, and indicators are lagging. That is why you should trade without them. All right, they are lagging. Let us just remove them. Let's just remove them. They're actually lagging. We don't want to use them. If you want to get serious with trading, remove all indicators from your chart. I tell my mentees, if you want to get serious with trading, remove all the indicators from your chart. It might take some time to master trading without indicators or without trend lines, but with time you're going to know. Let us also see, for example, you want to trade with the trend line. Let us see an example. Trading with trend line. If you are trading with trend line, you are at risk of having what we call the trend line liquidity. There's also what is called trend line liquidity. Okay, trend line liquidity. You might be taking a trade you might want to take a trade in line with it, with trend line, not knowing that you are actually at risk of liquidity. Let's say now you want to take trade like here. Now this is the market, this is the first touch, second touch, and now this is the third touch, right? So here you want to take a sell trade from here, okay, because the third touch of the trend line, not knowing that the market would break, the market would actually take out this liquidity. The market would try to take out this liquidity. And what did the market do? The market actually knew that there's going to be a liquidity pool right now. This is the first touch of trend line, second touch of the trend line, third touch. So some traders would take trades from here. Now the market actually gave them a piece of the cake, sold a while, but what did it do? It took out this trend line liquidity. All liquidity is placed, all stop loss is placed right here. Stop loss is placed right here. We are taking out, all right, taking out before the major sell, before the major sell right here. All right, so this is trend line liquidity. So why you should avoid using trend lines. In fact, trend lines are more reliable than indicators. Okay, granted, I need to be fair with you. Trend lines are more reliable than indicators. In the concept, in the hierarchy of reliability, trend lines are more reliable than indicators. Okay, they work better than indicators. But when you become a pro trader, or you get more advanced in trading, you discover that you don't even need a trend line, because you could expose yourself to trend line liquidity. So if you want to be more superior to trend line, you're more superior in your trading career, drop trend lines, drop indicators, use price action. Just focus on price action. You'll be safe, you'll be safer. Okay, so you can see in this case now the trend line failed. Trend line failed because there was a liquidity pool right here. There was a liquidity pool around here. So the market intended taking out this liquidity. All right, the market took out this liquidity. The market took out this is a liquidity pool. Okay, and this is where traders wanted to sell from. They placed their stop loss just above here, above this trend line, in order to sell. But the traders were not aware that there is a liquidity pool, and you can see the market gave them a piece of the cake and took out their stop losses right here before it now sold. So that is why you should avoid using trend lines. You should avoid using trend lines. All right, you should avoid using trend lines. It is not as reliable as you think. It's not as reliable as you think. The same thing happened here. This is a trend line. This is a trend line. The market has been respecting the trend line here, but in this case the market took out all liquidities here, took out this liquidity. Okay, it took out the stop losses right here, placed below the trend line. They wanted to buy from here, and now what we call breakout traders will now enter sell trades here, thinking that the trend direction has changed, and only for then they will now place their stop loss right here, only for their stop loss to be raided again. Their stop loss will be raided again to the buy direction. Can you see the dilemma? You can see the dilemma. This is the first touch of the trend, first touch, second touch, third touch. The market has been respecting this trend line, but in this case the market broke through the trend and took out all stop losses placed below the trend line. And then breakout traders will enter a sell trade, thinking that the direction of this market has changed because of the trend line break, and now their stop losses will be on the other side of the trend line. Their stop losses were also rated again to the upside. So you see that it is not reliable. It is not reliable. Okay, it is not reliable. And what happened here? The market was coming right here to mitigate this supply zone. All these were liquidities. The market was coming to mitigate this supply zone. So if I didn't have my trend line on, I wouldn't really bother, because this is a good supply zone to trade from. The market came and mitigated this supply zone. A wonderful trade. So drop trend lines, drop them. Indicators, drop them if you want to move ahead. So the third reason why your setups fail is that you combine retail strategies with smart money strategy, demand and supply strategy. Drop all of those and get focused. stop being confused. All right, stop being confused. So if you want me to mentor you, I can help you. These things, these concepts are just not as deep as what I actually will share in my mentorship course. All right, so if you want to join my mentorship course, do me a DM. My contact detail is in my free Telegram channel, and my free Telegram channel link is in the description box of this video. All right, so join our free Telegram channel. We post setups there almost every day, and those setups play out most of the times. Over 90% of the times, our setups play out. All right, so join our free Telegram channels for free setups that you can trade at your own discretion. And also, if you want me to mentor you, I have a lot of traders on my mentorship course, and they are doing very well. They are doing very, very well. I have a lot of testimonials to show you that this mentorship program has really helped a lot of traders. If you're a newbie trader, I can help you. If you are a struggling trader, I can also help you. I take you by the hand and help you until you become a profitable and a professional trader. All right, and I say why I do mentorship, why I do one-on-one mentorship is because I discover that every individual have their own learning curve. Some of my mentees, within a month they are done with the mentorship course. Some of them within 2 months, some of them within 3 months, and some within 3 weeks. It all depends on their individual learning curve. And I stoop to you, and I come down to your level. I am patient with you until you get it, until you get the concepts correct and right, until you get used to the concepts and become confident and become an independent trader. So do send me a DM, and we're going to meet next time. So this series is going to continue in the next week. We're going to continue on this series. This is just, there are about 7 or more reasons why your setups fail. So I just share with you three reasons. The first reason today I share with you is that you are trading against the order flow or market structure. The second reason is that you are trading without proper entry confirmations. The third reason why your setups fail is that you are using retail methods like trend lines and indicators and combining them with demand and supply or smart money methods or institutional methods of trading. So next week I'm going to share with you the second part of this series. So do not fail to watch the next week broadcast. So till I come your way next time, do have a wonderful day ahead. Bye.